Welcome back. All right, in the last video, I concluded my formal discussion of valuation, at least preliminary, laying out the foundation of valuation. We'll come back to valuation a couple of different times in future videos, but the kind of full presentation was completed in the last video. All right, I'm going to shift gears now to an incredibly important topic when analyzing a company, and you'll see that it plays a pivotal role as part of the foundation of valuation. Touched on it before, but we want to do a more formal discussion of competitive advantage. And you'll see in a minute why it plays such a key role in the analysis, but also in valuing any company, because it's critical to understanding future cash flows is really the company's, not just their competitive advantage, but their sustainable competitive advantage. I suspect we'll end up with 4 or 5 lectures on competitive advantage, maybe even 6 as I flesh out the various aspects. All right, let's get started. Okay, first, as I talked about throughout the valuation discussion, we really have established 2 layers of value. I call this the valuation stack, if you will. First layer is invested capital. Second layer may or may not exist. If the company is generating excess returns, then that second layer of value will exist. And I really want to delve into the sustainability of those cash flows. And that sustainability is very much linked to competitive advantage, as you can imagine. I'll set that up momentarily. And then the third layer of the valuation stack is that market implied value of growth, which I introduced in valuation, which is kind of the key to the whole lecture series, that value of growth. But we have to build up to it. All right, and as I said in valuation, every company should be worth its invested capital. If a company's cash flows are worth less than its invested capital, one of 2 things will happen. The company will either self-liquidate, there'll be no advantage to incremental investment, so the company will sort of shrink away. Or if in fact the company has the potential to earn its cost of capital, or maybe even earn excess returns, an activist of some form will come in and change management, either an activist hedge fund, or perhaps a private equity shop, or maybe just a strategic come in and buys the business. All right, so every company should be worth their invested capital. They should have enough cash flow to cover their capital charge. That's that first layer of value, that red layer of value. The second layer of value is derived from cash flows that come from excess returns. You're earning more money. The company's earning more money than their capital charge. Those are those excess returns. And then we want to value that layer of cash flow. Obviously, that's a critical component to valuation. All right, the only way we can use the perpetuity valuation formula, which I introduced in valuation, is if that layer of excess returns, those cash flows, are going to last for a while. Now, theoretically, they have to last forever. Practically, they got to feel comfortable 7 to 10 years. Now, a lot of people would say, Paul, I don't feel comfortable making that forecast. I would say just hold on for a second. Let's get through competitive advantage. And maybe with those tools, you'll understand that the exercise is a bit more straightforward than just a 7-year forecast. All right. So this is our setup. First layer of value is that invested capital. It's the cash flows to cover the capital charge. That second layer of value is derived from excess returns. That's cash flow above and beyond the capital charge. And then the third layer, which we're going to build to, that will be the next part of the lecture series, is that market implied value of growth. All right, now we know those excess returns are driven by a company's ability to earn a return on invested capital, ROIC, greater than its cost of capital. The problem is that's going to attract competition, and it always will attract competition. It's not positive NOPAT, positive earnings that attract competition. It is excess returns that attract competition. And that's because you're signaling to competitors, hey, this is a great business. You're signaling that to investors as well. And you're saying to those competitors, enter this business and you'll earn excess return if you can enter the business. So excess returns are going to attract competition every time. So we need to talk about competitive advantage. All right, so let me walk through a couple of definitional statements, and then we'll build from there, and then we'll come back in the next video and flesh some of this out. All right. Competitive advantage is defined by the ability to do something, that's in quotes, that is hard for other companies to replicate, at least well, right? They have to be able to do the same thing you do. That's kind of the base definition, if you will. Be able to do something that other companies can't do. And of course, we'll flesh that out. All right, that something must be unique to the company or possibly shared with a couple of industry peers. I'm going to push back on that. If you have too many direct competitors, almost impossible to maintain excess returns. We'll talk a lot about this in the next couple of videos. All right, so you could share that unique ability with one or two. I'm going to limit it to one or two industry peers. However, two things become important. You have to reinforce the moat. You have to reinforce those competitive advantages, and you have to contain rivalry. Right? One's external, that they're going to be companies trying to get into the business. So even if you're in a bit of an oligopoly situation, there's a couple of vendors, call it three, they share similar competitive advantages. You still have to keep other competitors out. That doesn't go away, even if you've got dominant market share. And very important, you need to contain rivalry between the three companies. Because if one of the companies breaks rank and decides to compete on price or some other promotional activity, the other two vendors are going to have to respond. We'll talk a lot about that. They're going to have to respond. They have no choice but to respond, and that's going to make the industry less profitable for everybody. So it's not just, it's necessary, but not sufficient to share those unique competitive advantages with other vendors. You also need to maintain barriers, no new entrants, no new interlopers into the business, and keep the rivalry between the three vendors at bay. Really important. All right, third, it's a bit redundant, but I just want to make this point. It requires a limited number of direct competitors, less than four, not four, less than four. I think industries can support four companies pretty well. Three's better. Five starts to get crowded. Now, you're often going to see in industries, the market leader is going to have, could have 25, 30, 40% market share. The next vendor is going to have 15, 20, 25% market share. The next vendor is going to have 10, 15. And then everybody else is going to split maybe 15, 20, 10, 15. A lot of industries are structured that way. That's a healthy industry structure. Too many competitors, really hard to maintain rivalry, really hard to generate excess returns over time. All right, this is critical to understand, particularly for the entrepreneurs watching the video. It's almost impossible to create a competitive advantage from scratch. And I will talk a lot about that through the next series of videos, right? So competitive advantage only accrues to incumbents and must be developed over time. I'll make that crystal clear over the next couple of videos. And there's no such thing as a challenger competitive advantage. We hear it all the time. Startup CEOs, even young companies, small market share, will say, this is our competitive advantage. And I will show that that is not true. What they're really saying is this is it's a relative product advantage. Maybe they're driving a disruption. Maybe they think the value proposition is better than the incumbents, but they don't have a competitive advantage, at least the way I define it. Maybe they have a competitive offering. Maybe they think they have a superior competitive offering, but they don't have a competitive advantage. All right, so no such thing as challenger competitive advantages. Competitive advantages only accrue to incumbents. All right, now you think a company has competitive advantage, there's a simple way to test it. Number one is consistently superior profitability over time. I think ROIC, return on invested capital, is the most important metric. So if somebody says they think a company has a competitive advantage, first thing I'll look at is their ROIC, particularly over time. And as we get further into this part of the lecture series, I'm going to separate the idea of competitive advantage, current, maybe right now, from sustainable competitive advantage. So this measure of ROIC is important, very important, to be kind of proof that the company has a competitive advantage. But as you'll see, sustainable competitive advantage requires that the company have high ROIC in the future. All right, concentrated market share. That's a direct from the last slide, obviously. What you want to do is look at market share over time. And it needs to be concentrated. The best businesses are the ones with concentrated market share. The worst businesses are the ones with lots of diffused market share, a lot of vendors. So if you have few vendors, like I just talked about on the slide before this, you should have concentrated market share, particularly over time, and limited number of competitors. Key, same thing. And then that market share should be stable. So not only is it concentrated, but it's stable in a well-defined market. Beverages is a hard market to maintain competitive advantage because it's a very diffuse market. Where does it start and where does it end? Whereas a regional service provider, that market is much tighter defined. Talk a bit more about that as we go. So I want stable market share. The best businesses have stable market share. Really important. I'll show some examples in the next couple of videos. And then I want few new entrants, almost by definition, right? I want the barriers to entry to be high. So I want, ideally, what's really great is evidence of failed entry. Companies announce they're getting into a business 6 months, 9 months, a year later, they're getting out of that business. That is excellent. Why are they getting out? It was too hard to gain market share. So this is really the evidence. I want superior ROIC over time. I want concentrated market share. I want stable market share. And I want few new entrants, ideally no new entrants. And I love it when a company or two or three try to get into the business and they fail to get into the business. So those are your 4 primary tests of whether or not a competitive advantage exists. Now that's just a competitive advantage. We do have to start thinking about sustainability of that competitive advantage. I'm going to try to separate those two concepts. Competitive advantage right now, which we know will attract competition because it has excess returns, signaling to competitors to enter the business, and sustainable competitive advantage, the ability to hold that competitive advantage over time. All right, so pricing, market price in a competitive market would be effectively, this is going back to microeconomic, should be the intersection between supply and demand. That should be the market price. And in this case, there's no excess returns. Now, a better way to think about it, I think, is demand and the industry average cost curve. And so in this case, price is going to equal the industry's average cost. That's where it's going to settle in a competitive market. This is where market price should settle in. Okay. And the key here is there'll be no excess returns. Now, there might be slight excess returns for the most efficient vendor, and there might be below negative excess returns, that inferior returns for a company that's poorly positioned. So there might be a company with slight excess returns, but as an industry, there's going to be no excess returns because guess what? The competition keeps price pretty close to the industry average cost curve. All right, so now we talked a lot about return on invested capital being our primary measure, primary indicator of competitive advantage, and that's that measure of excess returns. I think most people that are listening to this video know this metric, but it is essentially NOPAT, the cash flow you earn, divided by the capital you have invested to generate that NOPAT. You want to think about it, it's nothing more than a return measure. It's how much cash you're generating from a business or an operation or subdivision or whatever against the amount of capital you have invested in that business. And it's a very good measure of the capital efficiency, the financial return of the endeavor, right? How much cash I'm getting for every dollar or the total dollars of capital I've invested in the business. Now, what's kind of cool is we can separate this equation. We can pull it apart and now say that ROIC equals NOPAT divided by revenues times revenues divided by invested capital. And you'll see in a minute why that's a powerful construct. The ratio on the left is clearly a profitability measure, how much money I make for a dollar of revenues. That's my NOPAT divided by revenues. That's that profitability measure. The ratio on the right is revenues divided by invested capital. That's effectively an efficiency measure. And the nice part is ROIC is the product of those two. We're going to use this disaggregation in our analysis. All right, so here is a chart. This is a chart for Chipotle. I'm going to do a case study on Chipotle after we get through growth at the end of this. But I use their chart. It's the most current I have. And their ROIC in the most recent LTM, last 12 months, was about 23%. And you'll see that's a function of scale, which is on the left axis, and margins, which is on the right axis. All right. So as I said, the equation on the left, the ratio on the left is profitability. The ratio on the right, the equation on the right is capital efficiency. All right. Now we know profitability is price minus cost. I mean, that's not that tough. So to achieve a higher profitability than the industry, a company needs either higher prices or lower costs than its competitors. That's how we take that ROIC measure and we start to pull it apart and we use it in our analysis. All right. So for a company to achieve higher profitability, it needs higher prices or lower costs than its competitors. Rarely will companies have both. Sometimes they do. That's a pretty cool business. But most of the time, companies will focus on either higher prices, achieving higher prices, or lower costs. You kind of pick one or the other. All right. So the ratio on the left is profitability. It results in either higher prices per unit, right, just higher average selling price, or lower costs we just talked about. All right, let's talk about higher prices. Where does that come from? Now, if we go back to our chart and remember that competitive market price is where price is equal to the industry cost curve, that's the red line. And the company price, they've been able to price higher than the market. That's the key, or higher than what a competitive market would allow. That's that demand side advantage. The company's been able to to charge a higher price than it would in a competitive market. This effectively is a willingness to pay a higher price. The customers are willing to pay a higher price than they would in a more competitive market. That's the key insight. So what marketers are trying to do is figure out a way for the company to have a pricing strategy such that customers will be willing to pay a higher price than that you would see in a competitive market. And another way of saying it, as companies try to get into the business with lower prices, customers aren't changing. So we've got to talk about why customers are not changing their purchasing decision. All right. So you have to ask yourself is what is the source of those higher prices? And then you're going to ask, are those higher prices sustainable? Because if competitors come in, the most common entrance strategy is to lower prices. So if a competitor can get into the market, they're going to use price as their primary driver. Those prices are not going to hold. So you really want to ask, what is the source of those higher prices? And are those higher prices sustainable? What's driving the customer willingness to pay a higher price? All right, sales and marketing play a critical role in willingness to pay a higher price, obviously. We talked about that. And so if you're looking at a company and you're thinking about why are prices going to be sustainable, you might want to do some research on their sales and marketing capability. Is that strong, particularly relative to other competitors? All right, now let's flip it to the other side. Let's move from higher prices to lower costs as the source of higher profitability. That's lower cost per unit, total cost per unit. And then go back to the original chart where we said the supply and demand, right? Industry average cost is obviously right where demand hits. And this company you're looking at has lower cost than the industry. We refer to that as a cost advantage or a supply side advantage. You'll see in a minute. And you want to ask that question of what is the source of those lower costs and are those lower costs sustainable? So if we have a higher price, we ask questions of what's the source of those higher prices and are they sustainable? If the company has a lower cost or cost advantage versus the industry, we're going to ask sort of the same thing. What is the source of those lower costs? And then equally as important, are the lower costs sustainable? All right, so operational excellence plays a key role in keeping that cost advantage. So when you're looking at the operations of the business, if you believe that part of their competitive advantage is lower cost, that cost advantage, lower than the industry average, you want to really focus in on the operational aspects. How do they get those lower costs, and how sustainable is that? That's the key. And that's going to show up in your NOPAT margin. Your NOPAT margin is that blue line measured. This is, as I said, this is Chipotle, and they're continue to expand their NOPAT margin very impressively, which is the key. All right. Now we flip to the other side of the original ROIC equation, revenues divided by invested capital. Here we're really looking at capital efficiency. How much revenue can they generate for $1 of invested capital? And so here the key is business model design and capital allocation play a key role here. And we'll talk a lot about that, and I'll delve more into this. And this is really a scale measure, which you'll see in subsequent videos. All right, and then that's going to show up as our magenta or fuchsia or whatever that pink color is. That's the left scale. This is Chipotle. I'll go into more detail when I do a case study. The big drop was they were forced to capitalize their leases. And then you can see once that happened in 19, 20 was a tough year. COVID, of course, they have come back very strongly in terms of NOPAT margin and capital efficiency. They've done an excellent job. That's driven a much higher ROIC. In fact, almost at a record level for the company. All right, that's it for this video. We're setting up competitive advantage. Obviously, we have to dive into demand side competitive advantage, supply side or cost competitive advantage, and then scale efficiency and what kind of competitive advantages you get from that. All right, thank you very much for watching.